Hey everyone, welcome back to the channel. Today we're diving into one of India's leading chemical powerhouses, Deepak Nitrite. The stock is trading around 1727, very close to its 52-week low. So, is this a smart value entry or a risky trap? Let's break down the fundamentals, valuations, and entry strategy to see if there's real potential in this chemical giant. Deepak Nitrite is a diversified chemical manufacturer that produces intermediates, specialty chemicals, and phenolics, used across pharma, dyes, agrochemicals, and coatings. The company has built a strong domestic base and exports to global markets, which makes its revenue mix well diversified. In recent years, it has been focusing on value-added downstream products, a move that can improve margins once demand recovers. Basically, it's a classic Indian chemical story, strong fundamentals, but facing a short-term slowdown. Let's talk numbers. Revenue for FY26 so far has been stable to slightly lower year-on-year, showing that demand is holding up but not yet expanding. However, profit after tax has dropped due to higher input and energy costs, a common trend across the entire chemical sector. Margins have stayed in the 14 to 15% range, which, while lower than their peak, shows some resilience. The company continues to operate with virtually zero debt and a ROCE of around 16 to 17%, highlighting efficient capital use even during a tough phase. So, while earnings have softened, the underlying balance sheet remains very strong. That's the real comfort zone for investors. At current levels, the stock trades at a PE of around 38 to 40 times, which might look expensive, but remember, the market is pricing in a potential margin recovery. If demand and utilization rates pick up, there's 20 to 25% upside potential, with intrinsic value estimated between 2,100 and 2,300. Now, what works in its favor? A well-diversified chemical portfolio that reduces cyclical risk, strong process expertise across nitration and hydrogenation technologies, a debt-free balance sheet giving financial flexibility, and a growing export presence that positions Deepak Nitrite well for global specialty demand. But it's not all smooth. Rising raw material costs, weak global demand, and high competition continue to weigh on near-term profitability. For short-term traders, the entry zone lies between 1680 and 1740, with targets around 1,900 to 2,050 and a stop-loss below 1,600. For long-term investors, consider accumulating gradually between 1,600 and 1,750 and hold for a 1 to 3 year horizon, targeting 2,400 to 2,900. As margins recover and specialty volumes grow, this could turn into a strong compounding play. To wrap up, Deepak Nitrite isn't in deep value territory, but it's a solid quality play going through a soft patch. The fundamentals remain intact, and at current levels, it offers a balanced risk-reward setup. If you believe in India's long-term specialty chemical growth story, this is one stock worth keeping an eye on. My verdict: reasonably valued with 20 to 25% upside potential. Ideal for staggered accumulation and patient investors.